Hello again and welcome to Money Tips. This is Charles Kelly bringing you money tips to help you save, earn, invest, accumulate, enjoy more money. Thanks for joining me on Facebook Live. Hi to anyone who's tuning in there, and also on my podcast, which is on iTunes, but you can also find all the podcasts and all of the blog and the write-ups on it on my website, which is www.moneytipsdaily.com. Hope you're all having a good day, and I'd just like to talk to you about property today. Yesterday you may have seen that I was out in Wales and looking at properties there, and many of you saw my broadcast, and I was looking at properties there for, you can buy a two-bed house there for £60,000 and you can get it rented out, and it's not a bad little deal there. It's an area that's gone up in value. And in fact, I was looking at one of the most deprived areas in the country. This part of Wales is actually one of the most deprived areas in the country. But, you look around, you wouldn't realise that it was deprived because, people, there's no mess there. People look after their properties. It looks clean. It looks, it doesn't look run down, in other words, and people seem to drive reasonable cars. But it is statistically one of the most deprived areas in the country. Now, if you move then to one of the richest areas in the country, in Mayfair, you can buy a property which is actually works out at £66 million per room. So £60,000 for a house, or £6 million for a room. And in fact, it's the Ritz Hotel. The Ritz Hotel is up for sale at £800 million, which works out at £6 million a room. That's a lot of money. I don't know if you can do a rent-to-rent on that property. I don't think you can do a no-money-down deal with the owners, the Barclay brothers, but £6 million a room is a lot. So you can have £6 million a room in Mayfair or a 60 grand house in Wales. So which would you prefer? Now, I'm being flippant here, but the Barclay brothers they're nothing to do with Barclays Bank, by the way. They're property guys who have just made an absolute fortune. They're multi-billionaires, one of the richest two brothers in the country, and they paid, wait for it, in 1995 they bought the Ritz and paid 75 million for it in 1995, and even then it seemed like a lot of money because 1995 there was a big recession, interest rates were high, the country was in the depths of recession, and it seemed like it would never end. I had a property that I bought in the late 80s, early 90s, and it took until about 1997-8 until what I paid for it, until I could sell it for what I paid for it. So it stayed low all of that time, and it took 6 years or so to recover. So things were pretty bad. But in 1995 they paid 75 million for the Ritz, and now they could get 800. That's a 725 million pound gain. They made nearly 300-400% on their money. Now the Ritz would be considered to be a trophy purchase, like the Sultan of Brunei. I think he bought the Dorchester, and other very super wealthy people who buy hotels almost like a trophy purchase. I'm not sure if it's a good deal. So if you're thinking of going for it, I think it's a little bit overpriced. But then who knows? In 10 years' time, it might sell for 2 billion. Who knows? But ordinary investors need more of a good return on their money. People can buy properties with little or no money down. So if you want to get into property, let me know, and we can put you in touch with people who can maybe source properties for you in different parts of the country, or you can go on courses to learn how to buy property with no money down. There was a course today, a free seminar, free taster seminar. A couple of my contacts went along there, and that they really found it fascinating that it's opened their mind to the fact that you can get properties either no money down, or maybe putting your money in and getting it out again through refinancing, called rinse and repeat. That's buy the BRR, the buy, refurbish and refinance method, where you can end up with a property with none of your own money in, or just a little bit of your own money in, and then the income you get, it's like a perpetual return on your money. You're just getting infinite returns on that money with no money in. Normally when you think of putting £100 in the bank, you get 0.25% interest on that money. What's that, like a 25 pence or something? And that money is still sitting there for years and years and years, losing money against inflation. You can buy properties where you put your money in, you get your money out, or maybe you get someone else to put their money in, and you refinance later on, and then the income that you've left with, you're still left with rental income. That's like an infinite return, because you've got no money in there. You're earning money on money that you haven't put in, if you know what I mean. That's what I would call an infinite return. And lots of businesses done in the business world with other people's money. I was explaining a few days ago that banks are financing football teams to buy players. They're financing tours of pop stars. That companies are going onto the stock market and raising billions in a day for their businesses from shareholders. So there's lots of people are using other people's money strategy. They've been around for centuries. Other people's money has been around for literally centuries, where people have used other people's money to finance anything from the exploration days of Columbus, which was financed by a Spanish king to go and find gold in the Americas. From these things, he financed the ships and so on. So in your way, as a small investor, if you think, well, I've got ideas, I've got energy to go and find properties, I can find properties, but I haven't got the money to do it, then use some of these strategies, these no money down strategies. If you're interested, let me know. You can contact me at charles@charleskelly.net or through my Facebook page. And I want to talk about the word of the day. Oh, before I do that, obviously there's a bit of turmoil in the markets at the moment due to this potential war in Syria, with Turkey invading Syria to create what they call a buffer zone. I don't know why they can't create a buffer zone partly in their own land. They're going to go 20 miles into Syria just to create this buffer. But that's going to destabilise the market. There's still Brexit fears. There's still trade wars going on. So the markets are looking a little bit shaky still at the moment. And it's something like a war in the Middle East that has nothing to do with daily business in the UK or daily business in the US, can just trigger off a recession. They can literally trigger off a loss in confidence, a withdrawal of business funding and investment, and which can cause a downward spiral. So just watch out for that. And as I say, don't get caught with your pants down. Maybe that's why the Barclay brothers are selling off the Ritz. Who knows? I mean, I don't know. But they've had a good gain. They've made 700 million gain, plus they've made profits on whatever they earn from the Ritz. If you go there for tea, I think you maybe pay about £75-80 for an afternoon tea. And what is an afternoon tea? It's a few of these sandwiches with the edges cut off, cucumber sandwiches, and on a nice little tray of plates, and a few cakes and a cup of tea. I don't know if you get a glass of champagne thrown in with that, but it's people love the tea at the Ritz. It is a nice experience, listening to a chamber orchestra, etc. If you have a glass of wine in the Ritz, it will probably cost you £15-16. If you stay in a room, I'd imagine it would be several hundreds of pounds to stay in the Ritz. I've eaten in the Ritz, it's very nice, but I wouldn't buy the Ritz for 800 million or 6 million a room. So let's talk about the word of the day. Now this might sound obvious to most people, but capital gains. A lot of people get confused between capital gains and profits and income. Well, a capital gain would be what you make on the difference between what you pay for something and what you sell something for. So if you buy a property, for instance, for £100,000 and you sell it a few years later for £200,000, what is your gain? Well, your gain is obviously £100,000, and you would be taxed on that gain with capital gains tax, CGT, and you would pay tax on that gain. This is nothing to do with what you've made on the rent, because the rental income is taxed under a different schedule, and you'd be taxed on rent that you've made. You declare your rent, you claim expenses, but there's not many things you can claim, but you would pay tax on that rent. But that's a different type of tax to the gain. Now from the gain, you can usually knock off expenses. You can normally deduct expenses such as the buying and selling costs. So when you bought it, you may have paid stamp duty, you may have paid fees and surveyor's fees and that sort of thing. You can also deduct things like you've had to go in and spend a lot of money on the building, refurbishing it. You can usually deduct that, and then when you sell it, you can deduct costs of selling, like agent fees. And I'd imagine 800 million an agent fee on that. What's that at 10%, 80 million, maybe 1%, 8 million, 2%, 16 million. It could be a lot of money. Well, the Barclay brothers would be able to deduct that 8-10 million from the gain, so they wouldn't pay tax on the whole gain. Now, it might be different in a limited company. It might be different where you've got offshore companies, but capital gains is a major one, and it's the same in a business as well. You might buy a business for X amount and sell it for X amount. That's a capital gain. Shares as well. If you buy a share today, you buy a share in Apple and it goes up, then when you sell that share, you would pay capital gains tax, or you would be liable for capital gains tax. Now, in this country, you don't pay capital gains on the first. I think it's about £11,000 per tax year. So you can legally arrange your affairs to avoid paying too much in capital gains. So, if you had a basket of shares and you wanted to sell them, you might want to sell them in one tax year and pay a certain amount of tax on that, but use your exemption, your 11,000 exemption, and then you might want to sell them in the next tax year, which could be the next day or the next week, and sell that batch of them, and then use your allowance in that year, so that you use your allowance fully. Obviously, capital gains is a major factor in buying and selling things. There are ways where you can buy and sell properties without ever owning them, and thus avoid things like capital taxes and things like stamp duty. But generally speaking, the capital gain is what you would pay, is the difference between what you pay for something and what you sell it for. So that's capital gains. I think in other countries you might call it something different, but it's the similar principle, and most countries would tax this in some form or another. The tax system here is reasonably fair. It's not too high as in some countries, but if we do get a Labour government, then they've pledged that they would put up taxes, and that's not me sort of saying anything out of turn. That's a fact. That's what they would do. They'd want to put up taxes across the board to pay for other things. So that's all for today. Thanks for listening, and if you're looking at getting into property, you want to get into it perhaps with using other people's money, or using different strategies or tools to buy property with none of your own money, then let me know, charles@charleskelly.net, or drop me a line on my Facebook page on Messenger. Okay, thanks very much. Thanks for tuning in, all the guys. I've just waving to some of them here on Facebook Live. Thanks for tuning in, and thanks for listening on my podcast on iTunes and Stitcher, and check out my website, moneytipsdaily.com. Thanks very much. Bye for now.